You're not going to believe this, but I just discovered that 90% of LLC owners are paying themselves completely wrong, and it's costing them an average of $15,000 per year in unnecessary taxes. Hey there, welcome back to the channel. I'm Tiffany Phillips, CPA and tax strategist, and I help business owners legally reduce their taxes and keep more of what they earn. And if you're an LLC owner who's confused about how to pay yourself correctly, this video is going to save you thousands of dollars. Before we dive in, make sure and hit that subscribe button and the notification bell because I share money saving strategies like this every week that could literally transform your financial life. Now, the statistic I just shared isn't some random number I made up. Last week alone, I had 3 different LLC owners call me within the same day, all successful business owners making 6 figures, and all of them were making the exact same costly mistake. Rebecca owns a digital marketing agency and had been taking random draws whenever she needs money, sometimes $3,000, sometimes $15,000. No strategy, no planning. Marcus runs a consulting business and had been paying himself a salary of $8,000 per month thinking he's being responsible. What he didn't realize is this approach was costing him over $20,000 per year in unnecessary taxes. Jennifer owns an e-commerce business and has been so confused about paying herself that she's been leaving most profits in her business account, essentially giving the government an interest-free loan. All 3 of these smart, successful people were flying blind when it came to paying themselves from their LLCs. And it was costing them serious money. Let's start with the biggest misconception I hear all the time. LLC owners say to me, Tiffany, I need to put myself on payroll and get a W-2, right? Wrong. Dead wrong. If your LLC hasn't made an S-Corp election, and most haven't, you cannot issue yourself a W-2. Here's why. For tax purposes, you're a single member LLC. The IRS treats you like you don't even exist. They see you as a sole proprietor. Multi-member LLCs are treated like partnerships. In both cases, you're not an employee, you're the owner. And owners don't get paychecks, they get distributions. If this is already helping clarify things for you, smash that like button to help more LLC owners find this information. There are 2 main ways to pay yourself from an LLC. Method number 1, owner's draws. This is the most common method. An owner's draw is exactly what it sounds like. You're drawing money out of your business for personal use. You can write yourself a check, do a bank transfer, or take cash. Here's what's beautiful. There are no payroll taxes, no Social Security taxes, no Medicare taxes. You just take the money out, and at year end, you pay income tax on your business profits. Example. Let's say your LLC made $50,000 in profit last year. Whether you took out $10,000 in draws or $40,000 in draws, you pay income tax on the full $50,000 in profit. The amount you actually took out doesn't matter for tax purposes. This confuses a lot of LLC owners. They think, if I only take out $20,000, I only pay taxes on $20,000. Nope. You pay taxes on the profit regardless of how much you took out. Method number 2, guaranteed payments. It's less common but useful in certain situations, especially with multiple LLC members. A guaranteed payment is basically a salary you pay to yourself or other LLC members. Unlike owner's draws, guaranteed payments are deductible business expenses that reduce your LLC's profit. But here's the catch. Guaranteed payments are subject to self-employment taxes. That's an additional 15.3% on top of regular income taxes. For most single-member LLCs, owner's draws are the best option. Remember Marcus, the consultant paying himself $8,000 per month? He was costing himself over $20,000 per year. Here's what was happening. Marcus's LLC was making about $200,000 per year in profit. As a regular LLC, he was paying self-employment taxes on the entire $200,000. That's 15.3%. Over $30,000 just in self-employment taxes. Here's what we did to fix it. We made an S-Corporation election for his LLC. Now I know what you're thinking, Tiffany, I thought we were talking about LLCs, not S-Corps. Here's the beautiful thing about LLCs. You can choose how you want to be taxed. By default, you're taxed as a sole proprietorship or partnership. but you can elect to be taxed as an S-Corp while keeping all the legal benefits of your LLC. When you make this election, everything changes. First, you have to put yourself on payroll. You pay yourself a reasonable salary and issue yourself a W-2. This salary is subject to payroll taxes. But here's the magic. Any profit above your salary can be distributed to you as owner's distributions, and those distributions are not subject to self-employment taxes. Let me show you Marcus's numbers. Before his S-Corp election, the business profit was $200,000. Self-employment taxes were $30,600, and income taxes $35,000. Total tax $65,600. After an S-Corp election, his reasonable salary was $80,000. Payroll taxes on that salary, $12,240. Owner's distributions, $120,000. And income taxes were $35,000. Total tax, $47,240. That's a savings of over $18,000 per year just by checking a box with the IRS. Drop a comment below if you want me to do a deep dive on the S-Corp election process. But timing is everything. The election generally needs to be made by March 15th of the year you want it effective. However, there's a little-known provision for late elections if you meet certain requirements. If you make the S-Corp election, you'll face one of the most confusing concepts in tax law, the reasonable compensation salary requirement. The IRS says S-Corp owners who work in the business must pay themselves a reasonable salary before taking distributions. But what's reasonable? This is where LLC owners make expensive mistakes. Some try to game the system by paying tiny salaries, like $20,000, so they can take most income as distributions and avoid payroll taxes. This is a bad idea. The IRS will come after you. Others are so scared they pay huge salaries, giving up most S-Corp tax benefits. Also a bad idea. Here's how to think about reasonable salary. What would you pay someone else to do your job in your business? The IRS has salary data for every profession in every geographic area. They know what reasonable looks like. Generally, for most service-based businesses, reasonable salary is somewhere between 30 and 60% of total business income. Here are some real examples from my clients. Sarah runs a graphic design business making $150,000 per year. Her reasonable salary is $55,000. The remaining $95,000 comes as distributions. David is a financial advisor making $300,000 per year. His reasonable salary is $120,000. The remaining $180,000 comes as distributions. Jennifer owns a physical therapy practice making $400,000 per year. Her reasonable salary, $180,000, and the remaining $220,000 comes as distributions. Notice the pattern? As income goes up, the salary percentage tends to go down. Here's a key point. Document your reasoning. Keep salary surveys, job postings for similar positions, anything supporting the salary you're paying yourself. Now let's talk about advanced strategies that can take your LLC payment strategy to the next level. These are techniques wealthy business owners use, but most CPAs never mention. Strategy number 1, the solo 401k supercharge. If your LLC hasn't made the S-Corp election, you can set up a solo 401k. This allows you to contribute both as employee and employer. For 2025, you can contribute up to $23,500 as the employee, plus up to 25% of net self-employment income as employer contribution. Over 50, add $7,500 catch-up contribution. These contributions reduce taxable income dollar for dollar. Contribute $50,000 to your solo 401k. That's $50,000 less income you pay taxes on. Here's what most don't know. You can contribute up to 100% of net self-employment income up to annual limits. So if your LLC made $60,000 in profit, you could potentially contribute the entire $60,000 and pay zero income taxes on business income. Strategy number 2, health savings account, triple tax advantage. With a high deductible health plan, you can set up an HSA, literally the best tax advantage account in existence. Contributions are tax deductible, growth is tax-free, withdrawals for qualified medical expenses are tax-free. Contributions for 2025, $4,300 for individual coverage, $8,550 for family coverage. Over 55, add $1,000 for catch-up. Advanced strategy. You don't have to use the money immediately. Let it grow for decades for medical expenses and retirement. After 65, withdrawal for any purpose just becomes taxable like traditional IRAs. Strategy number 3, equipment purchase acceleration. If your business uses equipment, computers, vehicles, tools, machinery, furniture, use Section 179 to deduct the full purchase price in the year you buy it. For 2025, you can deduct up to $1,220,000 in equipment purchases. That's a massive deduction that can eliminate your tax liability for the year. Here are the key requirements. Equipment must be used more than 50% for business and put into service during the tax year. I had clients buy vehicles in December, use them for business, and deduct the entire purchase price. Completely legal and saves tens of thousands. Let me know in the comments which of these strategies you're most excited to implement. Here's exactly what you need to do. Step number 1, determine if S-Corp election makes sense. If you're making over $60,000 in profit, it probably does. Remember the March 15th deadline. Step number 2, set up proper payment systems. Is staying a regular LLC? Use owner's draws strategically. If electing S-Corp, establish reasonable salary. Step number 3, implement advanced strategies. Solo 401k, HSA, equipment purchases, these can save thousands more. Step number 4, plan distributions around tax deadlines. Set aside 25 to 30% of distributions for taxes in a separate bank account. Step number 5, document everything. Keep records supporting all your decisions, especially reasonable salary calculations. The difference between paying yourself correctly and incorrectly can be tens of thousands per year. Over your business lifetime, we're talking hundreds of thousands of dollars. That's not just tax savings, that's wealth building money, retirement money, your kids' college fund, your financial freedom. Look, knowledge without action is worthless. You can watch this video, nod your head, then go back to paying yourself the same way you always have. Or you can decide if this is the year you get serious about your financial strategy. If you're ready to optimize how you pay yourself and start keeping more of what you earn, grab my book, Your Biggest Expense: How to Legally Pay Less in Taxes and Keep More Wealth, at yourbiggestexpense.com. This book goes deep into all the strategies I mentioned today, plus more, that can transform your financial life. It's a practical roadmap you can start implementing immediately, plus exclusive bonuses to help you step by step. Before you go, make sure to subscribe for more money saving strategies. Hit that like button if this has helped you, and drop a comment telling me your biggest takeaway from this video. Remember, every month you wait to optimize your payment strategy is another month you're leaving money on the table. The wealthy don't wait for permission to keep more of their money, and neither should you. So remember, it's not what you make, it's what you keep. So keep more.